Okay, good afternoon, everyone. Welcome back to our options education webinar series. My name is Tony Zhang. I'm the chief strategist here at OptionsPlay. And I'll start by just saying I hope everyone is staying safe and are staying home and practicing our social distancing to hopefully do our part in containing this unprecedented time that we are currently in. Now, today we were going to cover maximizing OptionsPlay's tools and services, and I wanted to cover this because we've recently seen a lot of new subscribers join as members during these volatile times, and I wanted to make sure that everyone understood how to maximize everything that you are paying for and making sure that you are utilizing all the different tools that we have access to you. However, given the current market environment, I know many of you are more interested in understanding what's currently going on with the markets, how to go about positioning yourself. So I'm going to spend a bit of time doing both. And I'm going to try to keep things in the context of how you can utilize OptionsPlay services to help you maximize and to trade this current market environment. So I'm going to run through a few different slides, but I am also going to spend as much time as possible reviewing what we're currently seeing in the markets because things are changing very rapidly. Everything that I discussed with you on Tuesday morning, some of that stuff is still relevant, some of it no longer. So I want to update you on some of the research that we're currently looking at, what's developed, what's changed, and also a little bit about positioning in this market during these highly volatile times. So let's go ahead and get started. Before I do, just a quick for those of you that are brand new to OptionsPlay, if you do not have access to the tools that I'll be showing you here today, you can sign up for free using this link, which I will post into the chat window. For those of you that are brand new, you get a free 30-day trial to everything I'll be showing you here today. Plus, once you pass that 30-day trial, membership is just $75 a month or $500 a year. And for those of you that are brand new to options trading, you get a free 12-step options trading course to help you get started. And today, what we're going to go over is we're going to go over a few different things. We're going to talk about the technology platform, which is the core of what you're subscribing to when you join here with OptionsPlay. I want to discuss a little bit about the DailyPlay ideas because many of you subscribe to us for our ideas and you have access to the tools to leverage your DailyPlay ideas, but I want to review with everyone, especially for those of you that are newer to OptionsPlay. What are the rules for following these ideas? How do you actually go about placing these trades in the market? So I want to go over some of those things with you. For those of you that come to us for ideas, there are others that generate income for your portfolio. And I see, Sunil, you asked a question about writing cover calls. I will answer your question, but I want to make sure everyone also understands how they can generate yield in this particular environment. This is, in my opinion, one of the best times to generate yield for your portfolio. So how can you use cover calls and short puts to go about doing that in this type of market environment? Want to make sure everyone knows how to utilize these reports, and then also how to access the educational content that we produce. So every single Thursday, I'm here to do educational content for you guys to show you how to utilize options from a best practices perspective. But we've now added Tuesday and Friday market outlook overviews during these volatile times so that we can also discuss what's currently going on at the market, help you with positioning, show you some of the charts that we're looking at to give you an understanding as to how we're positioning ourselves for the market. And that's really what we're going to spend some time here doing today, looking at the current market outlook. So we're going to wrap a bit of education and a bit of market outlook into today's session, again, because of these times right now. So at the core of our platform, this is the platform that most of you should have seen or have access to. At the core of this platform, it's really designed to allow you to type in any symbol and be able to very quickly be able to look at bullish and bearish ideas to leverage whether you are bullish on a particular stock, looking at bullish strategies, or selecting bearish strategies to look at option strategies to deploy if you have a view on the market. And we leverage this for both trading and income because some of you here are here to speculate. During this type of market environment, many of you are, and others are here for income. Some of you just sell cover calls or sell cash secured puts. Nothing wrong with that. We produce analytics and trades for both. Now, normally I would spend a little bit more time on the platform showing you a little around the platform. But again, today, what I want to do, given the times, I want to spend a little bit more time on the market outlook, because I know many of you here are for that. And what I will do is I will do a special event separately just to go over the platform with you guys. And I will send out a recording to everyone for that, so that for those of you that want to have an in-depth review of the platform, I'll make sure that I cover that with you guys as well. So let's move on here. I want to talk a little bit about the daily play. The daily play is something that we send out every single day. We send you both bullish and bearish ideas with a specific options trade. And I just want to give everyone a bit of understanding as to how we arrive at these ideas, because many of you follow them, and I want to make sure that you guys understand how to go about doing so. So first of all, what we typically screen for are quantitative technical factors on an individual stock. And then what we do is we overlay fundamental security selection on top of that in order to arrive at a bullish or bearish stock idea. And what we do is we not only research the underlying stock, we also try to find strategies where we can find a suitable option strategy for that given stock. So we're doing the work that you would normally do yourself for you to give you a new idea as frequently as possible. And what we do is we always make sure that we provide both opening and closing transactions for you, so that you know when we are thinking about entering the position and when we're thinking about exiting the position. And I think it's really important that the most important thing that I want everyone to leave with is that if you're going to follow the options play, daily play ideas, my best advice for you is do not follow these blindly, meaning you should utilize the options play tool to analyze the trade. You should look up the security yourself. You should ask yourself, do I agree with this bullish or bearish view? Do I understand the option strategy before you go ahead and execute it? The worst thing you could possibly do is just follow what someone else is telling you blindly without understanding what you're trading, because at the end of the day, you're responsible for your own account. You're responsible for your own profit and loss. Make sure you know what you're trading before you get into that trade. Now, we deliver this every single day to you at 6 a.m. So for those of you that ask, how do you access it? There's multiple ways to access these daily play ideas. Number one, we send you an email at 6 a.m. every single day. You can also access it through this link at optionsplay.com/dailyplay. And when you log into your OptionsPlay platform, you get a pop-up that will show up when you log into your platform. So if there are 3 different ways for you to access these daily ideas that we send out, you can even look at the performance of these daily play ideas, which I will send out the link to everyone if you're interested in taking a look at a history of our daily play ideas. But the most important thing from my perspective is to know that you should not follow these trades blindly. Now, one of the things that I want to make sure that people check before you place a daily play trade is to see if the stock has moved. Sometimes we do the research at night, but by the next morning, the stock has moved a lot. I think Micron is an example of this. I think we put out the trade when it was around 37. By the time it opened, it already moved down to 35. It did trade back up to that level intraday, but if you didn't catch it in the morning, you may have missed that. So you want to make sure that you have access to the platform and you can adjust your trades accordingly. So if the stock has moved in the direction that we expect it to, but you think that it can continue moving, you might want to adjust your strike prices a little, or adjust the price of which you execute a trade at. It's really important that you understand that. So before I move on, how many of you follow our daily play trades? Just bring up your chat window at the bottom of your screen, and please type yes if you follow the daily play trades, and please type no if you do not. I just want to get a sense for how many of you here are utilizing this. Okay, great. So I see a lot of yeses. I see a few no's. Okay, for those of you that are not following it, that's okay. Hopefully that this inspires you to consider taking a look at it sometimes, and at least understand why you should consider utilizing it. Now, when you're thinking about, since so many of you have answered yes, I want to make sure that everyone understands how to place these orders. Number one, you want to always use a limit order to place these trades. I generally recommend that you don't place those orders until the market is opened, because you want to know where the market is when it opens so that you don't get a bad fill. And generally speaking, the rule of thumb here is you want to place a trade within 10% of the quoted option premium that we are telling you to trade at. So if we're telling you to trade an option that's, let's say, at $2, then you should have somewhere a maximum of maybe 220 on that limit order, or a minimum of maybe $1.80. So roughly 10%, somewhere in that range, do you want to place your options order if we quote you a price of roughly $2. Anything beyond that, if the market opens and it's trading at $3, then the trade has probably moved too far for you to start chasing this trade. You don't want to chase these types of trades. So the rule of thumb is usually try to stay within 10% of the quoted premium that we showed to you on the trade itself. And these trades typically are valid for no more than 1 to 2 days past the publish date. If something we published a week ago, I generally do not recommend that you continue to follow that trade or try to execute that trade. These are typically fairly time sensitive, and you need to have an execution within that same day, no more than 1 or 2 days past that. So I just want to make sure everyone understands that for those of you that follow our daily play ideas. Does anyone have any additional questions here on the daily play in terms of execution? If you do, please type into the chat window and I'll answer them at the end here if you have any questions regarding the daily play. Okay, so the daily play is the core of what many of you subscribe to OptionsPlay for. You come to us for our ideas, and we love sharing our ideas with you and sharing our research with you. So please make sure that you follow these rules when you're placing these trades. Next one I want to talk about is our weekly income reports. So what I just talked about in terms of daily play is for speculation. Purely, I have a bullish or bearish view on some stock in the market. For those of you that are investors, meaning you have stocks that you invest in for the long term, whether you hold them for dividends or you hold them because you believe they're going to appreciate in capital in the long run, a great way to utilize options for your portfolio as an investor is to sell options for income, cover calls, cash secured puts. Now, the difficulty of selling cash secured puts and cover calls is just the research that it takes to find the right expiration date and strike price. How many of you sell cover calls in your portfolio? Just please type 1 into the chat window if you sell cover calls or cash secured puts. Okay, I see ones flying through. Okay, so a lot of you are utilizing OptionsPlay or utilizing cover calls and cash secured puts. I hope that you guys are utilizing the income reports to some degree. These are income reports that we publish every single Monday. Now, we publish them Monday because your options, your cover calls and your cash secured puts, they expire on Friday. So when do you want to execute your cover call? The immediate Monday. So we send it out at 10:30 in the morning on Monday. We scan the markets roughly around 10 a.m. We give the markets a little bit of time to open and let the orders from the weekend flush through. We look at the options at 10 a.m., which by that time the bid-ask spreads are much more narrow. And then what we do is we publish these results for you at 10:30 a.m. So these are the most timely cover call ideas for you to implement on your portfolio. We cover the entire S&P 500 stock universe, and we give you the optimal cover call and the optimal short put based on the same techniques that we teach you on our cover call and cash secured put webinars. So if you've ever attended those webinars, we've taught you which expiration dates to use, which strike prices to use. We apply that to these reports so that you have a quick way to reference all the stocks that you currently own in your portfolio or the stocks that you want to own in your portfolio, and which expiration date and strike price you want to sell that following Monday once your options expire. For those of you that are a little bit more sophisticated and you're looking for more advanced screening tools, we've now added the implied vol percentile and the implied vol rank to these reports so that you can get an understanding as to which of these names out of the S&P 500 stocks have the highest implied volatility from a metrics perspective, for those of you that like to be very data driven in your tools. Now, These are available to you every single Monday, emailed out to you. But for those of you that want to simply, some of you I know want to just have these bookmarks. These are static links, so that as long as you bookmark them, you'll be able to access them every single Monday morning. And we always will show you on the report when they have been updated, so you can make sure that you are looking at the most updated report on every single day. So we will tell you when something's been updated. So when you look, just make sure that you're looking at the most updated report. But these are published every single Monday for all S&P 500 stocks. So I hope that those of you that are selling any type of cover calls or cash secured puts are utilizing these reports, because we're publishing them for you to be able to quickly research the stocks that you need to sell every single Monday morning. And it's best practice to do them Monday morning. If you want to generate yield for your portfolio, you have to get coverage as much as possible, which means as soon as it expires on Friday, the following Monday, you get into these cover calls. If you want to generate income for your portfolio, that is the ideal time to get into these trades. Lastly, I want to talk a little bit about the education. Now, all of you that are here are obviously here for our education. That's why you're on this webinar. So we cover weekly educational webinars on different option topics. We always record them. We always make the slides available to you. And you can look at the full video library of all options webinars. And you can sign up using this link here, but I don't think any of you here need it because you're obviously here. But we conduct these every single Thursday at 4:15 p.m. Eastern. This is really designed to make your options educational experience as rich as possible, so that we always follow the same format. I try to spend a bit of time using the slides to teach you the theory and the concepts. And then what we always do is we go to OptionsPlay and we show you with real examples how to apply what we're teaching you here. So that's always the format that I'm going to continue following. We're going to try to continuously improve the options education. We've moved now to a more course-like series, so that each month you learn a set of skills that you can apply immediately in the markets, and we try to show you how to apply them immediately. And we're doing a lot more on the live trading front, so that you can see how we're applying these in our own portfolios. And I really recommend, for those of you that are interested in our options education, if you're brand new and you're trying to catch up, follow us on YouTube. All of the education that we produce, all of the market outlooks that we produce are all available on our YouTube channel, so that you can follow us along and learn at your own pace. Everyone has, it takes a long time, in my opinion, to truly learn how to trade options. It's not something you can do overnight. So it's really important that you take the time to learn. And our YouTube channel is a great resource to be able to allow you to do that. And I'm really happy to announce, and this is something that really came out of this current volatility, we had so many questions from users saying, this current volatility, how do I trade this? How do I position myself? So we started doing these, I started with doing Friday morning sessions, because I thought it was a good idea to give you guys a review and a preview as to what we're currently looking at in the markets. And due to the current market volatility, we've now expanded to both Tuesday and Friday. I hope some of you here were able to join us for the previous few weeks. If you're brand new and you have not joined us, you can sign up for tomorrow morning's session using this link, and I just posted to everyone in the chat window, where we just simply go over the market overview. We share ideas and strategies, and that's what we're going to do a little bit in a few minutes here as well, because again, during this current market outlook, I want to make sure that everyone has their questions answered. So this is a new feature, if you will, of OptionsPlay, and I hope that you guys are able to utilize it, because it's a great way to stay on top of the markets and understand how to look at these markets, especially during these times. So with that, let's jump right into the current market environment. So for those of you that have joined me over the last few weeks on the Friday mornings and the Tuesday mornings, we've been talking about, are we heading into a recession? What does that look like? What are the models currently looking like? And I will say, over the last day or two, I think we are now at the point where I think it's pretty safe to say that 2020, we are going to enter a recession. There's no doubt about that, in my opinion, at this point. There is still a hope that by the end of 2020, we will come out of the recession, meaning that we do potentially see that this could be a short-lived 2-quarter recession. But nonetheless, I think it's important for us to realize that this is something that is likely that we are already in a recession. And so first and foremost, what we need to start thinking about is how do we position ourselves for a bear market and a recession? So we entered a bear market last week. We're now in a recession. How do we go about positioning ourselves? So some of the data that I want to share with you first and foremost is looking at things like implied correlations. And I have some charts to show you guys here over the next few slides. But implied correlations are very high. What does that mean? Implied correlations is the correlation of all stocks to each other. The higher the correlation, the more all stocks move in conjunction with each other. So when things are very high, this is something that we talked about on CNBC a few weeks ago. When implied correlations are very high, it's not smart, or I shouldn't say it's not smart. It's not very effective to pick individual stocks, because no matter what stock you pick, all stocks either move up or all stocks move down, depending on where the market goes that day. So when implied correlations are very high, generally speaking, this is a good environment to trade ETFs. And the reason for this is because when you trade ETFs, you're able to take advantage of these market swings when they move higher or they move lower. But what you're not susceptible to is single stock risk, because there are some stocks that will fall further than others. So sometimes you might say, I want to go long the market. Some bad news comes out. The thing about an ETF is that you're diversified, so that the most you might be down is maybe 7, 8%, 10% on a day. You're unlikely going to be down 20, 30%, which can happen in an individual stock. So in this type of market environment, generally speaking, what you want to focus on is really trading very, very liquid ETFs. And this predominantly is going to be an SPY and probably QQQ. So for those of you that are trading, SPY and the Qs are where I am predominantly trading these days. I will say the implied correlation did come off a little bit today, and we're going to look at some examples and so look at some sectors to see how things are shifting right now. Things are shifting very quickly, but implied correlations are still in the 70%, which is relatively high. So it's important that you know how to position yourself in this given market. I do want to cover a little bit today on selling options, because right now it's extremely expensive to buy options because volatility is so elevated. So I want to show you some strategies that we've been using to allow us to still have directional views by buying options, but offsetting some of that expensiveness by selling very short dated options. And I'll show you some examples of what we're currently doing to try to position ourselves for that. Now, the biggest unknowns that we currently have, and unknowns are the worst possible thing to have in trading. Bad news is something we can handle, but unknowns is worse. So the big unknowns that we currently have are the coronavirus containment trends. So we have trends out of China. That's our template. And the question now is, are countries like Italy, US, Iran, are we going to be able to follow in China's footsteps? Because we do not have the government of China where we can have draconian measures that effectively shut down an economy overnight and keep people isolated in their homes. We have not been able to do that here in the US. They have not been doing that in Italy. And the question is whether or not the containment trends that we're currently modeling everything off of using China's data will be consistent with what we see here. Now, I will say that we are just at the point where we are about to know whether or not that's going to be true or not. So it's really important that we keep track of this type of information. And I have some charts to share with you on that front. The second most, I think, important unknown here is economic impact. Now, the question is really across both magnitude and length, meaning how much of an economic impact do we see and how long do we see that going for? That also, we have Chinese data now to give us a sense for both the magnitude and length. However, again, we can't just apply what we're currently seeing in China to the US and Italy, because of the fact that we don't have the same draconian measures in place here to stop the spread of the coronavirus. So while we have a good sense for both magnitude and length for China, what we expect that things are going to shift here where the magnitude might be a little shorter. I'm sorry, it might be a little less in severity, but the length may be longer because of the differences in how our government is reacting to the coronavirus. The two new ones that have crept up over the last few days that I did not talk about on Tuesday, even though it's kind of in the back of our mind, but we're starting to see some of the cracks in the system are across, corporate debt. Looking at both investment grade and high yield debt, there is a lot of investment grade bonds that are just one notch above junk. There's about $3.4 trillion of BBB rated bonds, meaning investment grade bonds that are very close to becoming junk. And if they become junk, $3.4 trillion move in the corporate debt market is of great magnitude and will have ramifications for our debt markets. So the actions that the Fed has taken over the last few weeks is really in a response to anticipating this concern, right? We've seen huge inflows into treasuries. We've seen huge inflows out of both corporate, high yield and investment grade bonds into treasury yields. That's why we saw the 10-year yield move to 30, 40 basis points overnight and come snap right back to 1%. So I will say the snapback is due to the Fed operating and doing their liquidity in the markets right now, which normalizes things a little bit, but this is still a big concern right now as to what's going to happen to all this corporate debt. The second new item on the radar for us to look at right now is actually unemployment. So the estimate right now for Q2 is that there's going to be roughly 3.5 million jobs that will be lost during this time, and we're going to see roughly an uptick at the moment. Again, these are very early predictions, and these numbers are likely going to change very, very quickly as more numbers come out. But the current research shows that there's roughly going to see about 6.3% unemployment in Q2. Now that's more than double or almost double unemployment in just a single quarter. This is truly what we call a black swan event. Everything that we're seeing right now is basically happening at double speed or triple the speed of what we're seeing in 2008. So it's a very fluid situation. I will say, again, like I said with this first statement, that we are in a recession, is that we do in some degree expect that this recession, this downturn is going to be somewhat short-lived. The base case right now is that in Q4 and Q1 of 2021, we're going to pull ourselves out of that. That's the base case right now. But again, things are shifting a lot. 2 weeks ago, when we were looking at the economic numbers, we were saying that by Q3, Q4, we're going to be pulling ourselves back out of this. Now we've shifted back to Q4 and Q1 of next year. So a lot of things are changing. And again, we're here to do these webinars every single few days to keep you updated on the numbers, but these are the numbers that we're currently looking at right now. And I want to share with you, so that's at a very high level, what we're currently viewing on the markets. So here's the implied correlation chart. This is going from February. As you can see, before that February, this chart starts on February 19th. That was the all-time high of the S&P 500. We were at roughly 37, 38%, meaning stocks were not very correlated to each other. There was a lot of opportunities to pick individual stocks. Some stocks were moving higher, some stocks were moving lower. Fast forward 1 month here to March 19th here. Implied correlations were almost 100%, which means that almost every single stock was moving in conjunction with each other. We did see a big move to the downside today, down to about 70%, but that's still relatively a very high number here. That 70% of stocks are correlated to each other, which means that stocks are still moving in lockstep with each other. And again, in this type of environment, you don't have a lot of opportunity to pick individual stocks. You're better off trading these ETFs because generally stocks are going to move in step with each other. So I want to make sure everyone understands that, because this might not be a index or a metric that many people look at, but I think it's really important for options traders when you're thinking about, should I be picking individual stocks or should I just be trading the whole market? The research with implied correlations at these types of levels clearly show that you're better off trading the ETFs versus trying to pick individual stocks. So I want to make sure everyone understands that. Please type 2 into the chat window if that makes sense to you as to why it makes more sense in this type of market environment to trade ETFs versus individual stocks. Okay, perfect. The next chart I want to share with you is this is a chart that we've been looking at if you've been following us over the last few weeks during our market outlook. Is the aqua line is the line of Chinese new COVID-19 cases, and the chart always starts when the government starts taking serious action, which generally speaking is when there was about 100 new cases of coronavirus in a particular country. And as you can see here, what we see here is that China peaked around 21 days. And as you can see, Italy here is just at 21 days right now. And the question is Italy going to continue to rise before it starts to taper off? Or is it going to start tapering off immediately? Because my guess is that Italy is probably going to continue moving higher a little. And the reason that this chart is so important is because in order for us to measure the economic impact of this type of virus, what we try to measure is, and right now we have data out of China as to how much economic impact happens between here and here. In this particular case in China, we're seeing about 30 to 40% decline in economic activity during that time. So if Italy can follow a similar pattern where it starts to decline after 21 days or so, then we can also model out roughly the type of economic impact that we will see here in Italy. But even a few extra days of continuing to elevate will drastically bring the tail to the downside to continuously longer, which means that the economic impact will be more severe. So US is behind Italy by a few days. I believe the peak of US modeled based on China is going to be somewhere between this Sunday and next Thursday. So, we have a lot of data that we want to be looking at in the next week or so to give us an understanding as to whether we can use the data coming out of China to model the economic impact, or is it going to be a little bit more severe? So that's why tracking the number of new cases and how they're growing day by day is so important right now for trying to understand the economic impact to seeing this. Now, for those of you that are interested, this research comes out of Bank of America Global Research. This is something that for those of you that have access to a Merrill Edge account, which is the Bank of America's self-directed brokerage account, you will have access to the same research that I'm currently looking at for this. I read this research very, very closely every single day. It's really important for us to understand what's currently going on right now. So just to give you an understanding, based on that previous chart, the base case right now, given the Chinese data, is the base case is we're going to experience roughly about a 30% decline in economic activity. That's our base case. Again, that's based on the data that we're currently seeing out of China. We do have both a deeper and what we normally call a bull and bear case, right? The bull case is the fact that economic activity will decrease by roughly only 20%, and the worst case is roughly in the 50% or so. So like I said in that chart before, I think 30% right now is the base case. Given the fact that Italy has not declined before 21 days, I think the base case is probably, in my opinion, the best case scenario. I do think that there is a risk of going into this deeper model if that chart for Italy continues to accelerate to the upside. So these are some of the things that we're really keeping an eye out for. The question is, what was China's spike here? The question is, where did this one big spike come from? That big spike was actually due to the changes that they had in the testing. It wasn't actually necessarily because they had more cases. They just changed the way that they did the testing. But what we want to really focus on is this trend here, which is the trend of this decline. And that's the base case that everyone's using right now, and that's what we're modeling right now. So moving on to the debt market, this is something that's relatively new. This is something that I did not speak about on Tuesday. I will speak more about it on tomorrow for those of you that are going to be joining us tomorrow morning. But investment grade bonds and high yield bonds both have spiked heavily in terms of yields over the last few, let's just say, few weeks, but more likely more in the last few days. As you can see here, despite the recent spike, it is still well below the 2008 highs here. So we're nowhere near the 2008 highs, but we certainly have exceeded the previous 2011 flash crash, the 2015 taper tantrum. So there are certainly cracks in the market that we're seeing, but it's not quite 2008 bad. So we're not quite panicking just yet, but it's something to be on your radar as to where is the corporate debt market going to go, because that may cause a lot of issues that we're going to see in the markets. And I'll bring up some of the names that we're currently seeing on this particular list that is concerning to us based on this, but this is something that for us to pay attention to. The other surprise here was is on the employment side. So jobless initial claims, which is people filing for unemployment, had a huge spike. Now, I don't think the spike is surprising. I think what was surprising is the magnitude. We were looking at roughly maybe a spike of a few thousand, tens of thousands, but we had a spike of almost 60,000, 70,000 in the last week, and we obviously expect this number to continue to rise. And the question is, how much is that going to rise? Now, this really comes down to fiscal policy that the US government is going to step in with to give us a sense for the impact of all of this, right? Unemployment is obviously not good, but if the government can step in and provide longer unemployment for these, for many of the jobs that are lost, which predominantly is in hospitality and travel. Airlines have been laying off people, hotels, restaurants, obviously, hourly wage workers. We do have some of that being absorbed by other sectors that are seeing growth, such as the grocery market. If you look at Amazon, they can't keep up with the demand right now. That will absorb some of this, but the initial jobless claims that we've seen has surprised to the upside and will likely surprise to the upside. The only good thing is that we started off in a really, really healthy environment. So non-farm payroll in February, in March, early March, when non-farm payroll came out, it came out really strong. Unemployment was at 3.5%. So the good thing is that we started off in a really strong environment. So we do expect employment to be a big issue. And the question also is not just unemployment, but whether or not how much this is going to dent consumer confidence, because 70% of our GDP is driven by consumer spending. That is a huge risk to this market, is consumer spending. And the question is, if we have 6.3% unemployment, we have 3.5 million jobs that are lost, how much does that dent our environment? So those are the research pieces that we're currently watching. And I'll just point to the charts a little to provide a little bit of context as to what we're currently seeing. At this point, if you have any questions or if you have any charts that you want to take a look at, I'm happy to take a look at that. Or actually, before I jump to the charts, I do want to show you guys one more thing. I want to talk a little bit about trading during this extreme volatility. And I want to give you some of the pointers as to what we're currently doing here. So right now, volatility is through the roof, right? So these charts, what normally look like this, really look more like this. So an out of the money option volatility looks like that, and at the money looks like that, and then in the money looks something like that. So the question is how do we trade this, right? So the answer is that when you're buying options, they're so expensive, they rarely make sense to buy them outright. But I will say, despite the high volatility, because we're seeing extreme moves, buying options is not out of the question, even though for most of you that see the implied vol, ranks percentiles are in the 100%, you still need to buy the options in order to gain the directional views. It certainly doesn't make sense to sell options in this particular market. So, or at least just sell options is what I mean. So the way to gain exposure in this market is to try to buy longer dated options. So buying options somewhere out here, usually in the 3 to 6 month range, in the money options or at the money options to lower the cost of buying your options. And then what you want to do is you want to sell very, very short dated options, many times just a week out, maybe just even a few days out. I've been selling plenty of options that expire in just a couple of days to offset the cost of buying longer dated calls or longer dated puts. So that is the strategy to use here. And I'll go through some examples to give you an understanding as to how I'm doing this. But really selling very, very short dated out of the money options to fund the purchase of buying at the money or in the money options that expire, and much longer dated options to reduce the implied volatility that you're trading here. Many times what you're going to see is that when you're selling these very short dated options, you might be able to collect 20–30% of the cost of buying that long dated option in just a few days. So what your goal here is to try to do that multiple times. You want to try to do this maybe 3–4 times, and that will be able to offset a good portion of the cost of buying that in the money option. So I just want to make sure everyone understands that in terms of how to position yourself during this extreme volatility. I got a lot of questions asking, how do you trade this market? How do you buy options that are so expensive? The answer is you still buy them, and then you just sell really, really short dated options against it to try to purchase to reduce the cost of that trade. So let's just take a look at a few charts, and I'll give you some examples of that. But before I do, let's just take a look at some charts here. S&P 500. So what I have here on the left is a weekly chart. This is a chart from 2008, 2009 lows all the way to the February 19th high. We've retraced back at this point, after hours, it's down a little down to 237. So the 237 level is basically a 35% retracement. So we've basically lost a third of the move from 2008 to today, a third of the move. And just to put that into context, the average bear market is about 35%. So we are just at average. Now, the question really is, is this an average pullback? It's really hard to answer that question. Given the, and what I'm really looking at, to give us an understanding is really whether or not Italy continues to climb. If Italy continues to climb, my thoughts are that markets will continue to move lower. If Italy can start to normalize here and start to decrease the number of cases that it has, then we have a higher chance of calling this 237 or so, potentially a relative lower support level for now. To the move to the downside, I think 202 to 213 is the level that I'm targeting to the downside. If we do make a meaningful move below 237, hard to say which way we're going to go right now, but keep an eye out for 237. If we break below that, I do think that, 235. 235 is a level that I'm keeping my eye out on. If we break below that, I think that we could be heading lower to that 202, 213 level. If you look at the daily chart, the momentum certainly has slowed down a little. It hasn't continued to move lower. That's certainly good for building a base. Are we going to see a bounce? Maybe we might see a quick bounce, but I think bounces will be short-lived here. That's my opinion. We'll just have to see as far as how the markets play out here. But those are the levels that I'm keeping my eye out for. Let's take a look at the VIX. VIX did pull back quite a bit here today, but it still closed at 72. This is still telling me that this is a market that's extremely fearful of what's going to happen in the future. we have not seen volatilities this elevated since the 2008 financial crisis. I will say this is very different from the financial crisis, but markets are telling us things are still very, very volatile. Now, crude. This is an interesting chart to look at because a lot of these, the losses that we actually have seen can be contributed to this huge move in crude. Crude is now trading at 25 bucks, which is below pretty much everyone's break-even price on oil, meaning there's almost no country in the world that can get oil out of the ground for less than $25 a barrel. Probably Saudi Arabia is the only country that's close to break even right now. Every other country is going to be higher than that. And that has huge ramifications for the markets. XLE, the energy market, despite the fact that the energy market is now a shrinking portion of our economy, only about 5% of the S&P 500, but still, if 5% of the economy collapsed, there's going to be ramifications in terms of employment for this country, in terms of the debt, because energy companies do carry a high load of debt in this particular market. So that is the ramifications that we're currently seeing. So we are, interesting to see XLE rise about 6% today. The markets were kind of all over the place today. So if we look at the sectors, what's interesting is that consumer discretionary was the best was the best sector today, mostly driven by Amazon. Materials also, this is a very weak sector that did well today. Communications has been a relatively strong sector, and energy leading today. What's really interesting was seeing utilities fall by 5.8% here today. Normally when I see this type of price action, that tells me that the markets are less scared. When we see utilities pull off, when we see staples pull off, healthcare also pulling off, that usually signals to me a little bit more confidence in the markets, meaning we're selling these types of defensive sectors, or we're buying these really speculative sectors like energy, discretionary, financials. These are the industries that should be decimated by this coronavirus. Yet we're seeing these sectors show some strength today. So those are the types of days that I want to see in order for us to say we've now found the bottom in the markets. But I will say, I don't know that we're quite there yet. But that is the type of price action you do want to see when the markets bottom, is when we start selling off the defensive sectors and start buying the more cyclical sectors like we have seen here today. So those are the charts that I'm looking at. And I want to just show you guys some ideas here in terms of what I mean by utilizing long-term options to buy, and then short by selling very short dated options. So I'll use McDonald's here, McDonald's as an example, or why don't we use the index as an example? I'll use the Qs, since I've been trading the Qs, and I'll give you some of the examples of what I mean. So let's play two games, right? Let's play contrarian. Let's say we think that this is going to be a bottom here. 170 is a bottom here in the Qs, and you think you might get a short-term bounce maybe to a 190 or so. So let's say you buy a at the money call option. So we go out to May, and let's say we buy maybe a 180 call, a slightly out of the money call option. That costs you $1,400. That's a lot to pay for a 1.5 month slightly out of the money call option on a stock like QQQ. This has a break-even price of 194. That's even above the target that I have. So it doesn't make sense for me to buy a call option if the break-even price is above the target price that I have on this call option. So what I want to do is I want to show you how you can sell really short-dated options. We can even sell one that expires tomorrow. Let's say right now we're trading at 177 right now. I can sell a 183 that expires tomorrow for $2.06. So what I'm doing is I'm paying $14.07, but in a single day, I'm going to collect an additional $2 off of that. So what I'm doing is I'm reducing my cost basis from 1407, subtract 206. And so what I'm paying here is 1201. So now my new break-even price here on this particular, Let's do this. So I'm paying 1363 was the midpoint. I'm collecting $1.70 by selling the 183. So as long as the market isn't above 183 by tomorrow, I'm going to collect $1.70 to offset the cost of that 1360 call option that I have to pay. And that's just over a single day. If I can collect roughly about $1.70 multiple times throughout the week, then I can greatly offset the cost of this call from $13 maybe down to $5 or $6 in the course of maybe a week or two. And that's how you're going to be able to gain this upside premium or upside optionality while not paying $14 in premium. If we go out 1 week, let's say we go out to next week's option, then I can maybe sell the 190s for $2.78. So I can collect $3.10 there. So in a single week, I can offset roughly a quarter of the cost of buying that call option. And I have 43 days to expiration. And the goal here is to do this multiple times. Ideally, I would sell 1 week out, maybe the 183s that I said, right? Collect maybe $1.70. When that expires worthless, I'm going to go out to the following week, sell a higher call option, maybe the 187 or the 190s for a few dollars, and you keep chipping away at the $13 premium that you have to pay for that 180 call option. So that's the strategy that we've been using to try to trade this market. And the thing about trading this market is that you have to be really nimble. Chances are you're going to be flipping your directional views very, very quickly. For any of you that are looking at, let me just pull up, let's say, a 30-minute chart just to give you a sense for, the positioning here. This was the February 19th low. Chances are throughout this just couple of weeks, you probably had multiple times where you wanted to seek downside exposure, upside exposure, downside exposure, upside exposure, downside exposure, upside exposure. Look at how many times you would have changed perhaps your views just within a single week. These are massive 5-6% moves that normally would take weeks to move to happen that we're currently experiencing in a very short amount of time. This is the accelerated timeline that I'm talking about. And the question is really here is, are we building a base here? Are we going to build a base here and for the markets to start at least recovering a little and start trading maybe perhaps sideways here? So the question is, do we build a base here? Or are we just trapping a bunch of longs here and going to continue moving lower? It's hard to say, but I will, the research that I'm showing you here today is the research that we're looking at to help inform our decision as to long-term where we think the markets are going to go, and in the short term, how we're positioning ourselves utilizing options by selling short-dated options against a longer-dated option to collect as much premium as possible, selling very short-dated options to offset the cost of that long option. So I know I covered a lot of things here today, and I've gone a little bit over time, but I still want to try to answer some of your questions here. I know a lot of you have posted some questions here. So I want to thank everyone for taking the time out here this afternoon. I hope that this was useful in helping you understand, what services OptionsPlay has available to you, but also just understanding how to view this market, because things are really crazy and sometimes it's really difficult to know how should you position yourself for this market. I do have one bit of housekeeping. Next week, originally, I was going to have Tom Sosnoff on, but because of the coronavirus, his team has decided that they need to pull out. They can't support the webinar next week. So what I have is I have Michael Coe. So for those of you that follow us on CNBC, right now we're not even sure if we're going to be able to do CNBC. So I'm going to have me and Michael Coe next Thursday. We just sent out an email to let people know that we're going to be doing that next week. You have an opportunity to submit your questions ahead of time in that email. So for those of you that want to ask us questions, you're going to get 2 CNBC anchors at the same time. We're going to be talking about market outlooks, and we're going to be answering any of your questions. So please submit your questions ahead of time, because we're going to prioritize those questions above the ones that you guys ask us live during these sessions. So that's just a bit of housekeeping that I have for next Thursday. Again, Tom Sosnoff will not be on, but I will have Michael Coe on. And I'm really trying to bring Michael Coe onto these webinars more frequently, because I do think that having both of us, access to both of us, asking your questions, on CNBC, we literally get 2 minutes to lay out our idea, lay out our trade, and we have just about 20-30 seconds to talk about it. Here we can talk about it for much longer. We can get in depth into why we're looking at a specific trade, why we're trading a specific strategy, and we can answer your questions. So I hope that you guys can join us next Thursday on that. I'm really looking forward to having him on here with us. So I'll start off by just answering Sunil's question first. In the current market volatility, writing cover calls, is it better to roll those calls or capture the premium and wait until expiration? I will say in this type of market, you want to roll your positions very, very frequently. These short dated calls that I've been selling, like on the Qs, sometimes I've been rolling them intraday because I might sell an option for $3. By the end of the day, it's only at $1, and I'm rolling those immediately. You want to roll these very, very quickly. Take profits very quickly in this type of market environment. Let's see here. Laura saying the tracking worksheet for DailyPlay is more than a month old. Laura, check again. We actually just updated that. So we have a new tracking system in place that tracks these things in real time. So now you have a much better tracking system for our DailyPlays. Eric is saying, are the Tuesday and Friday AM sessions recorded? Yes, they are recorded, and we are sending it out to everyone for now, but they will be only available for subscribers starting in April. Greg is saying, having a hard time exiting profitable spreads when the market moves quickly. So I will say, in this fast moving market, this is part of the reason why I've moved a lot of my trading over to SPY and QQQ, because you need to prioritize liquidity right now. Trading Tesla, spreads are so wide looking at Tesla right now. I haven't touched that option. First of all, Tesla is not a particularly large cap stock to begin with, so the options are not very liquid, and you're trading something that's very, very volatile in a very volatile time, and that makes that turns the bid-ask spreads, instead of a few cents wide, a few dollars wide. And when you're trading a spread that's $10, $12 wide, you're talking about $1,000, $1,200 in spreads. So that's why, generally speaking, I will say in this type of market environment, you're better off sticking to the super liquid ETFs and really staying away from some of even the liquid stocks, because even those are not very liquid right now. Bob, would mutual funds do as well as ETFs? In theory, they should, but you can't actively trade mutual funds because you could only enter an order once a day. So I would much prefer trading ETFs because they are liquid. You can enter and exit them any time of the day. Things shift very, very quickly intraday. You want to have the option of being in and out very, very quickly. So I have a lot of questions here. I'll try to answer as many as I can here. If that is true, why are you sending out daily trades on single stocks and options? Notice how I've sent out 2 SPY trades over the last few weeks, and I've been keeping the single stock ones very, very limited because of this. And we're keeping them to stocks that we are scanning for that past liquidity scans on our end. What is the exception to what you just previously said? Amazon, an example, hasn't moved much since January. So there's always exceptions to the rule, right? No question about that. But as a general rule of thumb, ETFs are better in this particular market. I see a lot of questions that work. I think the context of it I've already lost, so I'm sorry I can't really answer to your questions because I don't know what you were referring to at that time. About what the x-axis, weeks or months or weeks. Sorry, I just don't know what that was referring to. So Raghu and Jake, when you're asking me examples about the volatility, I hope that this was a little bit more informative here. So I'm not talking about buying leaps. I'm just talking about longer dated 30, 60, 90 days out, usually is the time frame that we're looking at in terms of buying. Notice how I can buy a 90-day option for roughly $17, but a 45-day option half the time is $13. So only for an extra $4, I can buy myself double the amount of time. And if I sell short-dated options against it, I can really bring down the cost of buying that call option or that put option if you have a long-term bullish or bearish view. I just to give you an idea, I took some speculative positions in some of the airlines, and you could argue that that's a bad trade, but I was going out to June. I was looking at some really far out of the money call options. As you can see here, I can buy a $40 call option for $1.92 going out to, I'm sorry, I was looking at January 2021. I can buy a $40 call option for $3.75, and then I can sell a 1 week option. I can sell a $25 option for $2.80. So what that means is that if by next week the stock is not above $25, I've basically bought a $40 call option for less than $1. And this goes all the way out to January 2021. So I don't know that for a fact that the airlines are going to recover by then, but I can certainly buy my options for virtually next to nothing. So that's just an example of another way to play these types of long-term views that you might have, where you're hoping for a bounce sometime by next year, and you can fund these options by selling short-dated options against it. This was a trade that I had traded myself, just to give you an example. Can you analyze the Dow chart? Let's take a look at Dow. I don't look at the Dow, but I would. There's really no. I'm sorry. I don't look at the Dow, but the Dow chart looks pretty much exactly the same as the S&P chart. Actually, I will say it's a little different. So the Dow, the big level of support here is 20,000 on the Dow. Whether or not that will hold, the question is this going to resolve itself in kind of like a bit of an inverted head and shoulders here? Hard to say. I would say it's more likely that you're going to see this continue to move lower. That's my gut feeling here on Dow. And another thing I do want to talk about is just when you're investing in this type of market, use some common sense. What I mean by that is think about when you're making an investment or thinking about an individual stock, ask yourself a few different questions. Number one, will this company see an increase in demand due to the virus? So think about like stocks like Amazon or Clorox. These are stocks that are likely going to see higher demand as a result of this particular market. So if you're investing in a company, ask yourself that type of question. Think about which companies will see decreased demand from customers. Think about stocks like McDonald's and Shake Shack and Chipotle. That predominantly cannot shift their sales online versus stocks that can shift their stocks online, like Domino's Pizza. Domino's Pizza saw a big spike today. And I actually think the fact that, we talked about this stock before the earnings, it popped up to 380, came right back down to the level prior to earnings, and it's starting to trade higher again. I think this might be an opportunity to look at Domino's Pizza, because this is a stock where people might be ordering pizza in as they are stuck at home. Think about online shopping. Think about, whether a company will have to, will have to take a hit to their balance sheet as a result of the coronavirus. And there are plenty of names in this particular space. Think about the airlines. Think about the aircraft leasing companies, hotels. These are all companies that have now taken on huge amounts of debt to service their to keep their companies afloat. Royal Caribbean, some of the financial names, a lot of the semiconductor stocks. So there's, my best advice to you is that if you're going to invest in this market, use some common sense before you get into a trade with respect to whether or not you believe that stock will continue to benefit or have an impact from the virus. John is saying, can you review MU, which is the DailyPlay? Sure, let's take a look at MU. So I was looking at this stock simply because, we closed on a relative high around 37. One of the reasons I picked Micron is because Micron is a semiconductor stock that, you can say that China coming back online is a positive for this stock, but the fact that the rest of the world has shut down, which are the consumers of the goods that China produces, is going to will continue to provide a downside pressure on this particular stock. In addition to that, Micron recently had to increase their credit facility with their bank because they don't have enough cash to get through this, so they had to pull down their revolver. These are some of the reasons that I think Micron is going to underperform in the future, and that's why I'm using options to try to take that directional view. So that's what I was looking at. What happens if the QQQ goes above the sell price strike? So what you would want to do in that particular example is that you would want to buy back. If you're still bullish on the Qs, you would want to buy back the call. You might have to pay a small debit for that, but you want to maintain that short-term, you want to buy back that short-term call and then keep the long-term call that you have in that particular example. How about the cost of commissions for Canadians? Great question. So I will say that, trading actively in this market is a little bit more challenging when you're paying $15 in commissions. You would just have to trade less actively, unfortunately, unlike in the US where you can trade virtually for free now, where you can be very, very selective, or you can be very active in your markets. On the Canadian side, you just have to be more selective. And that means, in my opinion, looking at longer term charts, looking at daily charts instead of maybe 30-minute charts to make your trading decisions, because you're going to change your views less frequently than someone looking at a 30-minute chart. So it really just depends on how you're trading, but taking longer term views is the only way to offset the higher cost of commissions. A lot of questions here. I'll try to get through as many as possible here. What if the option moves in the money before you buy it back? So that's really where, when you're selling these really short dated options, your goal is to try to hold them to just a few minutes before expiration, because you always have the opportunity for the stock to go in the money and then go out of the money again. What percentage out of the money do you recommend to sell a call or a put? I will say, in this type of environment where you're selling 1 day, 2 day puts, 1 day, 2 day call or puts, you're better off using support or resistance. You're better off looking at levels on the charts to determine that rather than just a percentage point. You can use deltas. I usually try to sell roughly anywhere from a 20 to 25 delta. So that's usually where I like to start looking at my research. Richard, so you just let the sell side expire to get the credit? Absolutely, that's exactly what you do. Oh, the time decay graph. Oh yeah, so that's in months. So Dinkar, that x-axis is in months. Bill, Jim, thank you so much. Lucy, same thing. Jurgen, what about Tesla and Nvidia tomorrow? So again, both of those stocks are not very liquid, very volatile. I'm not touching those. You can if you want to, but I'm not going near those stocks at the moment. Those diagonals trades can lose money on a spike since the premium is greater than the width of the strikes. So Lori, you shouldn't lose money on those trades if you get a spike, because your long leg will offset the losses on that short leg. Richard, how far out should you go on the long dated leg? So that depends on where your views are in the markets. If you think that you're going to be in those trades for a few days, then I would say maybe go out a month. If you think you're going to be in the trades for a few weeks, then I would go out a couple of months. So it really just depends on how long you anticipate being in that trade for. If the QQQ moves up, we might lose money when selling the calls. So only in a huge spike will that happen, but generally speaking, you will not have that loss because the long leg will offset the losses on the short leg. Robert, yes, this is a lot to take in. Absolutely, that's why we record these. Michael, Bruce, that's right. What portion of premium do you recover by expiration or buy to close? Generally speaking, the goal is here is to simply let them expire worthless. Please post a link to the morning market update tomorrow. So if I'm not mistaken, it is, did I not post it here? I did, right? Here we go. So for those of you that want to join us tomorrow morning, the link is in the chat window. In the extreme volatility, the option you sell hits the strike price. What is the exit strategy? You want to buy back the short leg in that particular case. Thomas is asking, can you use the weekly income reports to structure and sell short-term bear call or bear call put spreads? Absolutely, you can. You can use those strikes as your strike prices. Thomas, you absolutely can. How did you find Delta? I didn't find Delta. It's just an airline that I follow very closely. My thesis was that the government is going to bail out the airlines, and you're going to see a recovery at least by the end of the year. That's my thesis, and I didn't want to spend a lot of money to bet that. So what I did is I found a really cheap option that I can buy. I went all the way out to January 2021, and I found a really short-term option that I can sell against it and basically buy that option for free. And that's exactly what I'm doing. It's a long shot, but I figured that if I can get that long shot for a few dollars or maybe free by selling these really short dated options when volatility is really high, that I was going to take that. And that's exactly what I did. Tony, when you play the airlines that way, rather than just selling naked calls on a weekly basis, use the long calls and anchor to limit risk. I'm not saying I'm not selling naked calls. The calls are covered because I'm long the call. So that's exactly what I'm doing, Steve. Eric saying high volatility equals trade smaller. Absolutely. So you can trade smaller, but also, because the option contracts are so much more expensive, you're just simply trading fewer contracts. So normally, when SPY options are trading up for a few $100, you might trade 5 contracts, but when the option contracts are $1,000, you might only trade 1 or 2 contracts. So yes, you are going to be trading smaller during higher volatility. What do you think of trying to time the markets? I think everyone's trying to time the markets, right? So you can use the charts to try to time the markets. I mean, that's exactly what we're all trying to do here, right? But, we look at levels to time the markets. We look at levels when the stock breaks below a level. That's a good time to enter the trade because then you have a very good risk reward. If the stock is down at 230 and I short the markets, then my risk is I'm only risking maybe $8-9 to the upside. I'm potentially making roughly $30 to the downside. So, that's how you go about timing the markets, is you use support and resistance levels, in my opinion, to do that. What platform is this? This is TradingView. This is a good charting package for those of you that want flexibility on charting and you want access to a lot of different global markets. Because I do follow Canadian and Nordic markets, I use TradingView to do my charting. Do you expect more rapid sector rotation due to news and volatility these days? I certainly do, especially when things normalize. I expect to see more sector rotation. When things are really crashing, that's when sector rotation doesn't really happen. So today was really the first day we saw some sector rotation in the markets. How is software faring? Software, I think, is one of the stronger sectors right now. I'm trying to find the software sector here. Software is within communications, and communications was relatively strong here today. Google, Facebook, everything has been higher. Disney is a big move up here today, almost 7% here. So a lot of movement here. There's no doubt about it. There's a lot of opportunities, but I just want to make sure everyone understands how to go about positioning yourselves correctly with all of these opportunities. When you send out a daily play, could you please also reveal whether you are bearish or bullish? So at the top of every single daily play, it will tell you whether it's a bullish or bearish play. Jake, Greg, you're very welcome. Michael, You're very welcome. KC, thank you. John, Lisa, Mohammed, Joe, thank you so much. Wayne, do you think of selling puts? Do you think if we are selling puts that buying the stocks at these discounts, or if they are put to us, is a good use of our total capital, or should we preserve our capital? So I will say, you know, in the grand scheme of things, right? You know, if you thought buying stocks a third of the way cheaper than you were going to buy back here in February certainly is a better price to buy them. You know, I will say that if you're going to sell puts, I wouldn't sell puts on your entire portfolio. I would sell puts maybe on a quarter of your portfolio, because if the markets drop another 10, 20%, you have some more ammunition to buy some more, because you want to average down your trades. You don't want to just go full boat into buying the markets. Even if you think this is the bottom here, I think that you shouldn't go full boat selling puts on the entire portfolio. I do think that it makes sense to sell some puts. I started selling some puts here on some stocks that I want to buy. But again, I'm not doing it on my full portfolio, because I do think that the markets can continue to move lower. If they do move lower, I'll still sell some more puts. And hopefully by the time the market bottoms, you know, I'm owning my stocks near the bottom. You can never time the market's bottoms exactly, but that's how you go about trying to do so. Where can we review this session? So I'll be sending out the recording to everyone after we finish here today. If you're far in the money on a bull put spread that expires the end of a bull put spread that expire at the end of mid-April on stocks, like, would you roll out? Hard to say, because it really depends on your views on those individual stocks. You know, the point of a bull put spread is that you have limited risk. You clearly got that trade wrong, or didn't anticipate the markets falling as much as they did. So my suggestion to you is simply take the loss and ask yourself, if you weren't already in a losing trade, would you enter another bull put spread? If the answer is yes, then you can roll it. If the answer is no, don't roll it. Just simply close out your trade and move on to the next trade. The best way to always think about whether you should roll a trade, especially a losing one, is ask yourself, if I'm not in a losing trade, would I get myself into a brand new trade right now? I find that 8 out of 10 times the answer to that question is no, and that's your answer. Don't roll it. Close out your position, move on to the next one. Can you drop a link to the weekly income reports? If you just scroll up, here, let me see if I can find it. Here, I just posted the link to the income reports in the chat window. Why did WTI spike today but not Brent? That's a good question. I'm not 100% sure, Alan. Will OT consider giving different suggestions? I'm not sure what OT refers to, Giovanni. Some countries like Europe started to ban short selling. Do you expect this will happen in the US markets? I have not heard anything like that. I don't see that happening in the US markets. I do think that allowing people, you know, it's hard to say. I don't think we should fiddle with the markets too much, to be perfectly honest. I'm not a big believer in intervening with rules. I think markets should, you know, the whole point of a free market is that people should be free to do what they want to do, and that is what makes a market a market. I think by banning shorting, you probably have some unintended consequences in there they probably have not thought about. The uptick rule, I don't think is necessarily a bad one. How much increased risk of being assigned is there now for selling spreads? I don't think there's any increased risk. If anything, there's a decreased risk in selling in assignment or early assignment here, because the premiums are so high. For you to assign early, for you to exercise early, you are giving up a lot of profit. So the higher the premium, the less likely you are going to be assigned early. So this is actually, in my opinion, better for that. Is that gradient overlay Fibonacci? Yes, that gradient is the Fibonacci retracement, but I don't really use Fibonacci retracements for the levels. I just use them to get a sense for how far have we pulled back here. So now I took a risk reversal trade and it's gone against me. Is there a way to repair or just take the loss and move on? So it depends on whether you've been assigned on the short leg or not. If you haven't been assigned on the short leg, I would just get out of the trade. If you have been assigned and you're now long the stock, you might be able to add a repair strategy to it, but a repair strategy only works if you're down maybe about 5 to 7%. So it really just depends on how far that stock has gone against you. I highly recommend you to watch our repair trades webinar where I go into that strategy in depth. Do you foresee the market may test its lows again? I do anticipate the markets to test its lows again. Again, this is based off of my anticipation that, what we're seeing here, we're kind of assuming that Italy follows this trend like China and tapers off after roughly 20 to 23 days. I have an inkling that this doesn't happen as quickly as we think it is, and it drags on substantially longer. Even if it just extends another week, this is going to drag that tail substantially longer. And both what we're currently seeing in Italy and in China, in Italy and the US, we're just not following this social distancing, I think, seriously enough. 56% of respondents in the Wall Street Journal poll earlier this week said that they don't anticipate coronavirus impacting their lives much at all. Meaning people are still going about their day as if nothing is happening. They're not taking this really seriously, and that's going to have ramifications. So that's my inkling that if things do turn a little higher, that we are going to retest these lows and potentially go lower. But again, we'll know the data in the next few days. So we'll keep you updated on that front. What do you think about a VIX collapse? So I don't trade the VIX because if the market rallies 10%, how much does the VIX go down by? There's no formula for that. The VIX is just the VIX. There's really no way to predict it, and that's why I don't trade it. Giovanni, no, those two trades would trade together. The delta, when I buy the $40 January leap and then I sell the March 27, 25 strike, those are traded together as a single strategy. Jake asked a really good question here, and I'm going to show you why I don't believe in this. So, and a lot of you here, right? You've been taught that when volatility is high, you want to sell credit spreads. This is not the environment to sell credit spreads, and there's a very good reason for it. And the reason for it is predominantly because when you sell credit spreads, you need the out-of-the-money volatilities to be lower than the at-the-money volatilities. And when things are normal, that generally speaking is sort of true. When things are really out of whack like they are right now, the out-of-the-money options that you're buying are so much more elevated than the at-the-monies that you're selling that you completely negate the benefits of a credit spread during a high volatility environment. So this is sort of the gripe that I have with Tom Sosnoff. And I was actually hoping to talk to him in depth next week, but unfortunately he's not going to be on. So you're going to have to wait till June when I have him on again. But, a lot of people don't understand that there's a difference between high volatility markets and when the volatility of a single stock is high compared to its historical. When we say high volatility right now, this is just completely blowing volatility out of the water. This is not just volatility is high or it's elevated compared to its history. This is just volatility is on a whole nother planet. So this is not a good time to sell credit spreads at all. First of all, things are moving very, very quickly. So if a trade goes against you, you're going to get your face ripped off in selling those credit spreads. And, I think a lot of people currently are in that position. People who sold credit spreads over the last few weeks have experienced a lot of pain in those positions, especially those of you that are selling really far out of the money credit spreads with 90, 80, 90% probabilities. You're seeing some severe losses in your portfolio. And even now, when volatility is high, the credits that you're receiving are high, but what you're paying for that out of the money option is even higher. So you've really negated this high volatility environment completely. So I think selling credit spreads is the worst possible strategy you can trade in this particular environment at the moment. Any good XLV covered calls to sell? Sure. I don't see why not. I'm sorry, did you use XLY? Sorry, XLY. So I would be looking at, let's see, short-term optimal, looking at the April 9th, 119.5, collecting, whoops, not 119.5, that doesn't sound right. Let's see. Oh, volatilities are so high, things are really kind of blown out of proportion here. Is this right? Some of these premiums don't seem right. Oh, so we're at 90 bucks right now. So the 107s, oh, it's the after hours. These prices are so wide, 7 cents by 5 cents. So you can't really go off of these. I would look at this again when markets are open. Look at where XLY is again. I don't trust these bid-ask spreads at the moment. So you can only look at these during the market open, unfortunately. Iron condors in this environment. Also, iron condors suffer from the same problem that credit spreads do. When you have to buy those out of the money options, they're so expensive. They completely negate the high implied volatility of the options that you're selling. So I don't believe iron condors are great in this environment. Plus, it's a very volatile environment. I don't know what stock or what ETF you're looking at that you think is not going to move in the short run. In what condition using short strangle to do day trading? Short strangle is not. I mean, Sue, it's hard to answer that question right now. If you don't mind, send me an email at info@optionsplay.com, and I'm happy to expand a little bit on that. What are the best strategies for high volatility? The diagonals and the calendars that I just explained before in Delta and in the QQQ, those are the best strategies in this high volatility environment. Okay, guys, unfortunately, I've gone so far over my allotted time zone time here today. I really tried to spend as much time as possible answering as many questions as possible. Thank you so much. I really hope that you guys have found this useful. I will send out the recording. This is a long one, so I hope that you guys are able to take advantage of this material, utilize it for your trading, and I hope that you guys choose to become members of Options Play. You know, especially during these volatile times, it's tough to trade these markets. You have to constantly stay on top of things, and we're trying to make sure that you guys have the right data points to look at, the right things to think about. You know, how big of a bear market are we going to experience in this particular market? And things are shifting all the time, so we're just trying to keep you updated on there and how to trade this and stay safe. So I hope you guys find this useful, and I hope to see many of you guys tomorrow morning at 9 a.m. And again, next Thursday, I'm going to have Michael Coe. So please submit your questions ahead of time if you want us to answer those questions, because I certainly will not be able to have enough time to answer all your questions next week. So please submit them in advance, and we'll get to them as much as possible. Please stay safe, and I'll see you in the morning.